Whether it's Ray Dalio talking about his investment into gold or other top investors, it's fair to say gold has been in the spotlight over the past few years. And it's not a surprise really, with governments worldwide printing vast sums of money and global investing risks growing greater than ever. So I've actually made a few videos recently about investing into gold, and you've been asking me the same question in the comments section. How? How do you invest into gold? Do you need to buy physical gold, or is it okay to buy something on the stock market which just tracks the price of gold? So I've been reading all of your comments, and in this video I'm going to do my best to answer your question. Do you need to buy physical gold, or is a gold ETF okay? So let's get straight into it. Gold is traditionally described as a hedge against inflation. In other words, you buy it because you think inflation is just around the corner. Well, with most countries printing vast quantities of money, like I say, many people would argue that inflation is highly likely in the coming years. Other people describe gold as a hedge against risk. In other words, if you think there is a lot of risk around, you'd buy gold. Well, again, with global economies suffering and unemployment skyrocketing in nearly every major economy, I think it's fair to say there is a fair amount of risk around right now at the moment too. Now, my personal favourite description of gold is like an insurance policy. I see gold as something to buy in case I'm worried about other investments not doing so well. Maybe in case something like the stock market crashes. Now, you might prefer the more traditional description of gold as a hedge against inflation. Gold as an insurance policy is just my personal way of viewing it. But I think the one thing we can all agree upon is that adding gold to our investments historically has made them a lot safer. Here we can see a list of some of the American stock market's biggest crashes in recent history. The column on the left shows the dates of the crashes. This column shows how much the S&P 500, or the American stock market, lost during these dates. As we can see, the numbers range from a 19% loss all the way up to 56%. And this column shows us how gold performed during these same dates. As we can see, gold grew in value every time, with just the exception of 2 occasions. And the 46% drop was just off the back of gold's major bull run, so a pullback was also not that surprising during these dates. Now, if we calculate the averages from the table and add them up below, we can see that the American stock market lost 30.5% on average during these dates, while gold actually gained 7.9%. So you see, for me, gold is something I look at more closely when I'm either concerned about inflation or I think there's a lot of risk present and the stock market could crash. But here's the thing. Remember, I described gold as an insurance policy. Well, you don't invest everything into an insurance policy either. Smart investors tend to invest a percentage of their overall money into gold. It could be anywhere from 5 to 25% of our portfolios. It really depends how confident you are about the next 12 months. The more confident you are in the stock market, the less you might invest into gold. And the less confident you are in the stock market, the more you might invest into gold. So we know the purpose of gold when it comes to investing, but the question is, how do we buy it? Do we meet someone in a dodgy back alley to buy some gold bars? Well, not quite. So there are 2 main ways you can invest into gold. The first is the most obvious. Simply buy some physical gold. There are many reputable stores online where you can buy physical gold these days. So if you're a larger investor, you can buy substantial bars. For medium investors, you can purchase smaller bars. And for us smaller investors, you can maybe purchase some gold coins. Now, you're probably thinking, buying physical gold online, how does that work? Well, you can either generally have it sent to your house to look after yourself, or you can pay to store it in a vault. Now, there are of course pros and cons with both approaches, and I'm going to circle back to what these are later on, as I want to introduce the second method of buying gold first so that we can discuss the pros and cons of both approaches so you can figure out which best suits you. So the second method of investing into gold is to buy something known as a gold ETF on the stock market. Basically, a gold ETF allows you to gain exposure to the price of gold. So if gold increases by, say, $250, your investment will do the same. And if gold falls in value, again, your investment will reflect this. As you can purchase an ETF through the stock market, you can invest very easily using your traditional brokerage or apps like Robinhood. Now, This sounds great, right? You can buy something easily on the stock market and it tracks the price of gold. Well, with this ease of use, there are certain disadvantages. You see, the way it works is that a trust buys physical gold. The trust then appoints a trustee, and the trustee will hire someone to look after the gold in a vault. They're known as the custodian because they take custody of the gold and have the job of storing it safely. So if you aren't buying actual physical gold and you buy an ETF, what exactly are you buying? Well, when you purchase an ETF, you're buying shares, but the key thing is that these shares are backed up by physical gold in a vault. And that's why when gold increases by, say, 10% in value, the shares should increase by the same amount. After all, they are essentially a representation of gold. But that word, the word representation, highlights the biggest downside. When you buy a gold ETF, you're buying a representation of gold. You're not buying physical gold that you can personally hold. There is a level of trust that you're putting into the people who created the trust and the people who are storing it to keep it safe. Now, I'm going to use iShares' gold ETF with the ticker symbol IAU as our example. Why? Because they are the second largest gold ETF around and they offer competitive prices. You see, there are certain fees associated with storing gold, of course, and these are handed down to the investors. For the largest ETF globally, GLD, the fees are 0.4% per year, whereas iShares offer a fee of 0.25. And I know it may not sound like a huge difference, but when you're talking about passive investments in pretty similarly safe products, I would always generally pick the cheaper option, as these differences in fees can actually add up quite surprisingly over the course of many years. So for the iShares ETF, who do we have to trust? Well, the trustee is the Bank of New York Mellon, and the custodian is JP Morgan Chase Bank, specifically the London branch. Now, here is where the risk of the trust comes into play. As per the prospectus, the value of the shares will be adversely affected if gold owned by the trust is lost or damaged in circumstances in which the trust is not in a position to recover the corresponding loss. The custodian is responsible to the trust for loss or damage to the trust gold only under limited circumstances. Essentially, the custodian is on the hook if they mess something up, but if there are losses due to nuclear fission or fusion, radioactivity, war, terrorist event, invasion, insurrection, civil commotion, riot, strike, act of government or public authority, act of God, or a similar cause that is beyond the control of the custodian will not be responsible to the trust. So I'd recommend you read through any prospectus before investing because there will likely be some terms in there that you find surprising. And it's not like you can go and collect your gold from the vaults either. Yes, you may own shares which are directly backed up by physical gold, but you can't collect your gold whenever you want. That is, unless you own a basket of shares. But a basket of 50,000 shares is worth just shy of $1 million. And I don't think there's many of us who are investing that much into gold. So when it comes to the pros and cons, the first con for the ETF route is that you have to trust the custodian and the trustee. This is known as counterparty risk. And to be honest with you, it really depends what you think. Some of you won't trust these organizations as far as you can throw them. And some of you will consider that the risk is quite minimal considering the safeguards in place. It's really not my place to tell you what to do or how to think. My only aim is to highlight the facts so that you can make an informed decision about what you want to do. On the flip side, the ETF route does have some major advantages. As they trade on stock exchanges, you can buy or sell them with just a few clicks on your phone, and you don't have to worry about keeping the gold safe either, as professionals are employed to do just that. Now, of course, there is a non-zero chance the vault could be robbed, but I don't know about you, I'd personally say that it's much less likely that's going to happen than my house is going to be robbed if I choose to keep my physical gold here. Now, of course, I could alternatively store my gold at a vault that I choose, but then again, you run into the risk of theft, and the vault may charge you pretty hefty fees. Another advantage for the ETF comes from the price difference between what they pay for gold and what you or me would pay for gold if we purchased it physically. Now, you see, when you buy physical gold, there is usually a premium, a higher spot price that you may pay or I may pay above what the ETF would pay for the same amount of gold. So you might actually get slightly more gold for your money by purchasing through an ETF. I also think purity issues are far less of a concern. When you buy physical gold, you are trusting that whoever sold it to you is selling pure gold. Or you can inspect it yourself, but I don't know about you, I wouldn't know where to begin when it comes to inspecting gold purity. However, with an ETF, there are experts checking the purity. And again, I don't know about you, but I trust their judgment a lot more than I do my own on this. For physical gold, there are advantages too, though. Physical gold can be held privately, whereas an ETF is obviously highly trackable. Physical gold also doesn't charge you a fee to store it. If you want to keep it in your house, you won't have to pay 0.25% per year as you would with the iShares ETF. Although, if you want to keep it in a vault and you want to manage it yourself, again, you will have to pay a recurring fee. But the single biggest advantage of buying physical gold over an ETF is that you have it. You can hold it in your hands, you can take it with you where you go, and you can use it in times of panic. And this really is the difference that I think of when I consider buying physical gold over a gold ETF. In my opinion, a gold ETF is all about investing. It allows you to hedge your portfolio by betting a percentage on the price of gold. Buying physical gold, on the other hand, is about having portable money that you can take with you in times of desperation. I've personally been very fortunate to grow up somewhere where I haven't had a need for this in my life so far. But there are numerous times in most countries throughout history where people have needed gold. Not as a hedge in case the market crashes, but for much more pressing concerns in their life. George Gammon summarized this brilliantly in a video he did on the difference between buying physical gold and gold ETFs, which I recommend you check out as well. And I'll include a link in the description so you can check that out after this video. Now, I'm going to tell you what I've done, how I've purchased gold, whether that is through an ETF or if I've been buying physical gold. But first, let's summarize the key points so far. So when it comes to buying physical gold or a gold ETF, it, in my opinion, really depends what you're looking for. If it's to keep your money safe as you fear much more than just a stock market crash or high inflation rates, physical gold is probably best. If you're just looking at this as an investment, then ETF is obviously much more simple and more liquid. But again, you do have counterparty risk, so you need to have faith in the trust and the custodian. I can't tell you what to do, and again, it's really not my place anyway. All I can do is highlight the pros and cons of both approaches and tell you my experience and how I've bought gold. So, have I chosen physical gold or a gold ETF? Well, in the UK, we have something known as a lifetime ISA. Basically, if you deposit anywhere up to £4,000 in your account per year, the government will add another £1,000 on top. In other words, the government will give you an extra 25% for free on just one condition. You either spend the money on your first property or on your retirement when you reach your 60s. In this account, you can keep the money as cash or you can invest it as you would in any typical brokerage like Robinhood. So you can buy stocks, ETFs, etc. And whatever you do, you still get the 25% bonus. So if you know you'll be buying a property in the next few years, as I'm hoping to, or you'll be retiring, it's really a no-brainer in my opinion. If you're in the UK and you are in a similar situation to me, please do some research on the lifetime ISA. There aren't many times that the government will give you free money, will top you up by 25% for something that you might be wanting to purchase anyway. Well, as most of my investing money is actually held in there, outside of some active cryptocurrency investments, I have no real choice but to buy a gold ETF. Sure, I could withdraw my money and buy physical gold, but I would instantly lose 25% of it, and that's just not a trade-off that I think is worth making. So when it comes to me, my gold investment is in an ETF, not in any physical gold. If I had more money outside of this account, that's an interesting question. I imagine I would probably still invest mostly, the vast majority, into ETFs, but I may hold a very small portion of physical gold too, just to hedge my bets. Now, that is just my personal perspective on things, and like I say, everyone's got different thoughts. I'm really just sharing my own personal opinion. Another interesting topic is gold miners. Some people prefer to invest into companies that mine gold instead of, or as well as, just investing into gold. I don't want to take up any more of your time in this video, and it would take a long time to go through, so I'm going to link a video in the description by Invest with Sven Carlin. It's a great video where he breaks down the pros and cons of investing into gold miners in great detail. Now, you're probably wondering at this point how gold fits into your investments, and most importantly, how to build a diversified portfolio with gold included. Well, click up here now to learn how to do just that. And of course, thank you for watching.